Market returns have been robust throughout 2017, partly driven by strong corporate earnings growth. While we see a continuation of this theme into 2018, longer-term challenges do remain. Consumer spending accounts for the majority of U.S. gross domestic product. When consumer confidence is high, it often translates into continued spending, which helps support our economy. The University of Michigan's Consumer Sentiment Index is trending higher, and consumption continues to be strong. This is supported by a steady increase in asset prices, which include market gains as well as an increase in home prices. Now, these are typically two of the largest assets owned by consumers. Additionally, unemployment continues to decline as more jobs become available. In fact, the unemployment rate is now near levels we haven't seen since 2000. While wage growth is beginning to wake from its slumber, we have yet to see any meaningful rise in inflation. Wage growth challenges may persist partly due to the increasing number of higher skilled and higher paid baby boomers exiting the labor force due to retirement. Now, as long as inflation remains benign, the Federal Reserve will have the flexibility to gradually increase rates. The selection of Jerome Powell as the next Fed chair was a signal to the markets that the continuation of the gradual normalization of monetary policy will continue. The Fed is planning to raise rates 3 times in 2018. However, this is above current market expectations. If the market feels that the Fed is raising rates too quickly, there will likely be an increase in market volatility. An ongoing disconnect between the Fed and investors would also likely prompt additional flattening in the yield curve. Should the yield curve invert when short-term rates represented by the blue line become higher than the long-term rates in red, it would put the next recession in our sights. An inverted yield curve has historically been a good predictor of recessions, represented by the shaded areas. However, we do not foresee a recession in 2018 or 2019. In fact, we expect to see GDP growth pick up for a period of time in 2018. This is due to the tax reform, which will provide a reduction of tax rates for both personal and corporate income. The tax reform is expected to stimulate personal consumption and business investment. This fiscal stimulus should help offset the less accommodative monetary policy and has the potential to boost economic growth and corporate earnings. The U.S. leading economic index rose again recently, suggesting that solid economic growth will continue over the next few months. The U.S. is not the only country expected to experience growth. For the first time in a decade, the Organization for Economic Cooperation and Development, or OECD, is forecasting that every one of the world's 45 major economies it tracks is expected to grow in 2018 and 2019, albeit at a slowing rate. So what's not to like? Well, as mentioned earlier, consumer sentiment and asset valuations are high, while market volatility has been low. This suggests a degree of complacency. We expect market volatility to pick up in 2018. Some of the challenges we may face include continued tightening in the labor market, which has the potential to increase wage pressure and inflation. This would force the Fed to tighten more rapidly, and that's not something currently expected by investors or priced into the market. We also face the difference in interest rates between the U.S. and other countries, which may cause the dollar to appreciate and dampen exports along with the value of foreign investments. In this environment, it's very important that your investment objective is the correct one for you and your circumstances. If you're a current client, I expect that this is something you've been periodically discussing with your trust officer. If you're not a client and you'd like to learn more, we'd welcome the opportunity to provide you with a complimentary portfolio consultation. It's confidential and free. Well, thank you for joining us. We wish you and your family all the best in the new year.